This is Alpha, a unique perspective on the market. We're following the chart trends of the sentimental money model as we dive into today's pre-market observations on the U.S. stock market. Previous trading day. On Wednesday, September 3rd, technology stocks reclaimed their lead, driving a mixed U.S. stock market. Driven by a surge in Google's parent company, Alphabet, the Nasdaq 100 rose 0.79%. The S&P 500 rose 0.54%. However, the Dow Jones Industrial Average closed essentially flat, down 0.04%, dragged down by energy stocks. Sectors. The market showed significant divergence. The communication services, XLE, sector surged 1.67% on Alphabet's surge, while the technology, XLK, sector also rose 0.6%. However, the energy, XLE, sector plummeted 2.24%. U.S. Treasury prices surged, driven by a report showing rising private sector layoffs and concerns from a Federal Reserve official about labor market risks. The long-term Treasury bond ETF, TLT, rose 1.1%, and the 10-year Treasury yield retreated to 4.211%. Gold prices continued their gains, with the gold ETF, GLD, rising 0.78%, reaching a new all-time high. The cryptocurrency market performed positively, with the Bitcoin ETF, IBIT, rising 1.27% and the Ethereum ETF, ETH, surging 4.86%. Following a positive ruling after Tuesday's closing bell, shares of Google's parent company, Alphabet, surged 9.1% on Wednesday. The court's decision, which avoids harsher penalties such as a breakup of its business, significantly boosted investor confidence in technology stocks. Media reports suggest that OPEC Plus may decide to increase production after its meeting this weekend to alleviate global fuel shortages. This speculation led to a drop in oil prices, with shares of U.S. oil producers suffering widespread losses. Retailer Macy's saw its stock surge 21% after it raised its annual outlook. However, the company also warned that economic pressures such as tariffs in the second half of the year could make consumers more selective with their spending. Next, let's take a look at some noteworthy stock news today. First, this is about Amazon, the e-commerce and cloud computing giant. The company's growth engine is undeniably powerful. According to its latest financial report, the company's total revenue in the second quarter increased by approximately 12% year-on-year to $167.7 billion. Its two most profitable businesses, cloud computing and advertising, performed even more impressively, with revenue increases of 17.5% and 22%, respectively. This strong performance was directly reflected in the bottom line, with operating profit increasing by 31% year-on-year, and both gross and operating profit margins steadily improving. However, within this seemingly perfect financial report, one data point has raised concerns in the market. Amazon reported a 2% decline in Prime membership registrations in the United States. While the company's overall subscription service sales are still growing, the slowdown in membership growth in its core markets may indicate that consumer spending patterns are shifting amid inflationary pressures. Of course, Amazon itself is actively addressing these challenges. For example, it recently launched an AI-powered shopping tool called Lens Live to enhance the user shopping experience. Furthermore, it's worth noting that senior executives, including the company's CFO, sold a total of over $8.69 million in stock in August. Therefore, for investors, Amazon currently presents a complex picture of a strong core engine but a yellow light on the dashboard, reflecting a frightening sign. U.S. consumer spending appears to be weakening. Second piece of news. Regarding the diabetes market, Senseonics, SENS, a diabetes device company, has just announced a major strategic shift, essentially becoming independent. According to the announcement, the company has signed a memorandum of understanding with its partner, Ascensia Diabetes Care, to fully take over the global commercialization and distribution of its Eversense 365 continuous glucose monitoring, CGM, system, effective January 1, 2026. To support this transition, the company has appointed a new chief business officer and secured up to $100 million in non-dilutive debt financing to build its own commercial team. So what's the difference between selling products yourself and having a partner do it? The key lies in profit. Senseonics expects its gross margin to increase significantly through direct sales, from an expected 32.5% to 37.5% in 2025 to 50% in 2026, and ultimately exceeding 70% after achieving economies of scale. Of course, this shift comes with significant investment and risk. The company projects that operating activities will consume approximately $60 million in cash in 2025 alone. This is a high investment, high-risk bet for Senseonics in exchange for higher long-term profits. The market will closely monitor whether it can successfully achieve its goal of doubling its global patient base by 2025 to support this ambitious transformation. The third piece of news. This is about Intuitive Surgical, ISRG, the undisputed leader in surgical robotics. This company's growth story remains remarkably strong. According to its latest financial report, the company saw a 21% increase in second quarter sales and a 23% jump in adjusted earnings per share. The core driver of this growth was the increasing number of surgeries performed with its robotics. Data shows that the number of surgeries performed with its core Da Vinci robot increased by 17% year-over-year, while the number of surgeries performed with the newer SP platform surged by 88%. However, behind this impressive performance, there are several dark clouds worth noting. First, the company's chief financial officer, CFO, recently warned of a volatile tariff environment, raising concerns that the impact of future tariffs on the company's profits may be greater than previously anticipated. Second, the company is undergoing internal adjustments, including plans to lay off 331 employees to improve production efficiency. While this may be for long-term development, it also reflects the company's current pressures. Finally, we also note that CEO Gary Guthart sold nearly $20 million in stock between late July and late August. It is precisely this interplay of tailwinds and headwinds that has led Wall Street analysts to maintain a cautiously optimistic outlook on the company. Next, let's look at the FS model analysis results and see what specific trading strategies should be implemented in the U.S. stock market today. It should be noted that this model does not fully consider the impact of current market news. It only demonstrates operations based on internal rules and does not constitute investment advice. First, we modeled and analyzed the top 200 stocks in the S&P 500. Today's trading actions were as follows. Stocks bought: Guild 112.99, CME 269.35, Orly 103.84. Stocks sold: LNG 239.39. Stocks held: AZO 4189.48, MCK 690.84, BSX 107.53, WMB 57.73, KMI 26.73, WM 224.41. Over the past year, this strategy has outperformed the S&P 500 fund SPY by 17.06% in this group of stocks. Next, we modeled and analyzed the top 200 stocks in the S&P Midcap 400. Today's trading actions were as follows. Stocks bought: none. Stocks sold: none. Stocks held: TKO 186.61, UNM 72.78. Over the past year, this strategy has outperformed the S&P 500 SPY fund by 29.59%. Finally, we modeled and analyzed the top 200 stocks in the S&P Small Cap 600 Index. Today's trading actions are as follows. Stocks bought: Coop 189.24. Stocks sold: none. Stocks held: CNR 71.28, EAT 159.06. Over the past year, this strategy has outperformed the S&P 500 SPY fund by 0.03%. The above information is just a few perspectives on the market and does not represent the entire real world. Please consider all valuable information and consider your investment and trading strategies accordingly.